Today, I have the pleasure of introducing one of our premier partners, MAG Capital Partners, and joining me today is their Chief Operating Officer, Neil Walgren. Thank you for joining me today, Neil.
Thanks for having me, Lee.
So to start off, we just want to know a little bit about your background and your history with MAG, how it all came together and what you've been doing.
Certainly. So I'll start with myself. So Neil Walgren, I'm the Chief Operating Officer at MAG Capital Partners. From the San Francisco Bay Area in California. Grew up out here. My background actually was a military cargo pilot for the U.S. Air Force out here for many years. Got to travel all over the world, and over the years, I finally hit the end of that chapter and decided commercial airline flying was not quite the outcome that I wanted, and started looking at other ways to really be able to grow wealth in a really scalable way, in a securitized way, and be able to really take on an industry that allowed basically controllable risks in a very similar way to flying, and that's ultimately what drove me into the commercial real estate side. So I worked for a number of kind of small equity focused companies where we would partner with different operators. And that was how I originally got introduced to the principals at MAG Capital, and ultimately had the opportunity to join them shortly thereafter. So I've been with Dax and Andrew working side by side since late 2016. The company was founded in 2015 by Principal Dax Mitchell. So Dax is from the Dallas-Fort Worth area. He's been a commercial real estate broker for coming up on 25 years now. His father was a developer, really just in it since he was, barely crawling and walking. Ultimately, he cut his teeth selling and buying largely single-tenant net lease properties, and it was some industrial, some medical office, some retail, but all in that very exclusive kind of credit-focused single-tenant net lease investment structure. So he was buying and selling for other investors and investment groups, and then starting after the Great Recession, began investing on his own and with small groups, and eventually grew that platform to MAG Capital Partners in 2015.
That's awesome. Such a diverse background you have had up until now. Mm-hmm. So tell us a little bit more about MAG, the history, the deal, track record.
Yeah, absolutely. So currently, as of June 2021 here, we are, our current assets under management are about 24 separate investments. And I'll clarify that we do strictly direct investments. So each one of our investment opportunities is for a particular piece of real estate or a limited scope portfolio of real estate, always tenanted by a single tenant. And really that is our mantra, is buying and selling single tenant net leased, largely industrial properties. So right now we have about 240 million assets under management. We've also, separately from that, we've bought, held, and sold an additional roughly 100 million across about 14 full cycle properties. So, of them, in average, our buying criteria is between roughly 5 and 50 million. So it really ranges. We're opportunity buyers. So we go through, and largely we are buying through a mechanism called sale leaseback. And what that means is we go in, we are typically buying industrial real estate that's tenanted, fully occupied by a manufacturing company, largely in the U.S. Midwest area, and that's Texas, Oklahoma, Nebraska, really that central corridor all the way up to Michigan, Illinois, Indiana area there. But that tends to be kind of a manufacturing hub within the U.S. So we go in, and typically these companies have recently been acquired by either a stronger company or a private equity group looking to basically purchase that company and absorb its assets and operations and ultimately continue its growth. Those larger acquiring entities will often prefer to remove the real estate from that acquisition, and they sell the real estate to us, and simultaneously they will sign a brand new, typically 15 to 20 year absolute triple net lease. So they are effectively removing the capital from the real estate that was owned by the company they just purchased, and then they take those proceeds and reinvest it back into the business. And that might be lowering debt, that might be, capital improvement investment, new manufacturing lines, new headcount, really whatever it is that acquiring company thinks is the best use of those assets to continue to grow the company they just bought.
So there's lots of opportunities that must come across your desk. How do you choose the opportunities you actually go into, and what process of DD do you follow?
Yeah, it's a great question. So when analyzing the risks and rewards of a single tenant net lease, it's going to be slightly different than other commercial real estate asset types. So, just to make a comparison to, say, a multifamily apartment investment, on those, you are typically buying a underperforming asset, and you do heavy market research, right? You're looking at demographics, you're looking at household incomes, you're saying, hey, how can I improve the occupancy, improve the rents of this multifamily investment after I purchase it. We are taking a slightly different view, where we are taking more of a defensive posture. So our asset, our industrial building is fully occupied. There's pre-built-in rent bumps that are pre-negotiated into the lease. So really, we're looking to protect that cash flowing asset. And the way we do that is by doing a heavy deep dive, first and foremost, into the creditworthiness of the tenant. So we have a credit advisory team, a 3-person team led by a gentleman who actually led the credit team for a publicly traded single tenant net leased REIT in the US. So gentleman's name is John Den, and John and his team will look at the full financial picture of these tenants, ultimately with a goal to say, hey, how has their historical financial performance been? How are they going to use the proceeds from this sale? And their end result, is it strong enough that we feel comfortable that they will be able to comfortably pay rent for the roughly 4 to 5 years we plan to own this real estate? So that is the risk, and that is how we approach that risk, by ultimately creating a fairly extensive credit memo that accompanies every investment opportunity in this space.
So with those pre-negotiated rent bumps along the way, is that how investors gain value out of your opportunities, or are there other ways that you have?
Yeah, so the way I explain the value proposition of these investments is highly securitized cash flow during the hold period. And that's largely because we are buying a fully occupied asset. So there's no ramp up of cash flow. It cash flows to a high level, typically 8, 9, 10% from day one. And we pay that out fully to to our limited partners. And as those rent bumps kick in, again, we know with a high degree of certainty that free cash flow to our investors is going to come up. And the way we know that certainty is through the mechanism of the triple net lease. And so just a quick review, the way the lease is structured, we have effectively removed and transferred all of the expense obligations of owning the real estate. So our tenant now, instead of us, our tenant directly pays their property insurance. That includes deductibles and premiums. They also directly pay their property taxes. They pay their own utilities, and they even include capital improvements, building maintenance, such as a new roof, new concrete, new landscape, paint, HVAC. I mean, literally 100% of the costs of owning real estate have gone from us as an investment group to our tenant. So what that means is we have a highly predictable, consistent level of cash flow during that hold period that we collect and distribute to our investors. And then the second part of your question, how do we build value? So that's going to be, how do we build appreciation and equity in the real estate itself? So largely 3 ways. The first is we get very long-term, consistent fixed rate debt. So every month we're paying down principal on that debt, and that's building up equity in the project. The second, which is probably the most impactful, is as those rent bumps come in, because we have no expense line, every 2% annual increase in rent directly correlates to roughly a 2% annual increase in net operating income, NOI. And the way these investments are valued, you take your cap rate, you take your NOI, and it's a multiple, and that ultimately dictates what you're able to sell it for at the end. And then the last piece, quite often, and this last piece is a little more subjective, but we've had, really a strong track record in it. And that's, when we're buying the real estate, typically these companies are just being acquired by a stronger backer. And if that, say, private equity backer of this manufacturing firm is successful in what they're trying to do, over the next 4 to 5 years, they may be able to significantly grow the revenues, the profitability, the growth of that tenant company. And 5 years from now, if we're sitting on a stronger tenant from a credit perspective, we call that credit enhancement. So better revenues, better profitability, whatever that may look like, that ultimately reduces the risk when we go to sell it, and we're able to sell at a premium and build value in that way as well.
And then everyone wins upon exit.
Absolutely.
Absolutely. So predominantly you have only had US investors into your deals, and now through our partnership you are branching out into international investors. Why is now the right time for MAG to look at international investors, and what excites you about our partnership?
Yeah, quite a bit actually. So we've largely been growing through kind of organic growth, and really that's how you and I got connected. Just through, I believe, a mutual connection, and ultimately, we've gotten to the point, kind of internally, where we're able to have fairly consistent, high quality deal flow based on the strength of our investor network, and our opportunities are directly tied to the strength of our equity group. And by expanding, largely we've been somewhat limited based on a lot of regulatory rules and really just outreach limitations to the US market. But we believe even on an international scale that US real estate consistently has really just strong baseline growth with limited downside. And we see that securitized by a number of different factors, but we recognize, especially from a comparative level, U.S. real estate investing is relatively attractive compared to similar real estate investment in other nations or areas. So we're excited to be able to take in investors that see that opportunity and partner for really long-term relationships in that respect.
Well, we are very excited to be introducing you to our community and for the partnership that's going forward, for the many deals that we are going to be doing together and bringing them to our marketplace. So thank you very much for joining us, and we look forward to a long, profitable relationship.
And likewise, Lee, thank you for having me.